very active. They have some really very diversified economy. But I think that the pileup of debt is a really big problem for them. They also have a complete lack of population growth. Even changing to a one-child policy to a two-child policy is unlikely to really impact birth rates all that much. So I think that China is going to shift to being a much, much lower growth country, which I think is really bad news for all the commodity producers who have predicated their entire business models on the idea that there will always be more demand in China in the future than there is in the present. On the other hand, I see other emerging countries in very different situations. I think that India is in a category almost by itself, in the sense that most other emerging markets are still commodities producers. If you look at Brazil, Russia, Argentina, a lot of these countries are still major commodities exporters. Their currencies move in lockstep with commodities prices. So if China slows down, it's not really very good news for them either. U.S. production, which I think is pretty bearish for crude oil prices. We also have pretty high levels of inventory. I guess the good news for crude oil, if you're long crude oil, is that the inventories have come down a lot from where they were a few years ago. But the bad news is they're still, if you look at where they are today, they're higher than they were at any point prior to 2014. There's still a lot of oil out there in storage, and that might not be a positive story for oil prices going forward. In terms of metals, metals also have a very, very strong correlation to the growth rate in China. That's true for copper. China consumes 40 to 50% of the world's copper supply each year. So their need for housing, railways, and other things are having a big impact on that price. Very, very high correlation about 1 year out. Same thing with aluminum, not surprisingly. Very high rates of volatility and very flat yield curve. You get a recession. We had a recession in the US in 1990 and 1991. So what did the Fed do? The Federal Reserve cut interest rates. As they cut interest rates, the yield curve steepened. So by 1992, we had a much steeper yield curve. Volatility began to fall. As volatility fell, the markets got very calm. What did the Fed do? The Fed raised interest rates quite a lot in 1994 and 1995. So by 1996, we found ourselves in a state that resembles a lot where we are today. We had a much flatter yield curve, but markets were all very calm. Nobody cared. Nobody thought there was any real risk. But as the Fed flattened out the yield curve, things started going wrong. So in 1997, of course, the Thai baht fell off its peg, created an emerging market currency crisis. And by 1998 and 1999, we had this explosive combination of high volatility and a very flat yield curve. And so what happened? Well, around the year 2000, technology stocks hit their peak. Technology stocks crashed, the NASDAQ index. And so my sense of what's going to happen is that the Fed is going to continue to tighten. They all know intellectually that there's something's going to blow up eventually. And these people aren't stupid, they all went to great schools. But sometimes you can have a group of people who are all individually smart who still do stupid things when they act together. And I think that's what the Federal Reserve is going to do. I think that they're going to over-tighten. I think they're going to get this yield curve really flat. And I think the market can still stay really calm for another year before it all blows up. And if you look at this cycle in equity index options, it's not alone. That exact same cycle exists for treasury options. If you just replace the VIX index on the S&P 500 with the MOVE index of US Treasury options from Merrill Lynch, you see a very, very similar pattern. And once again, for that too, the year 2018 looks a lot like the year 2006, which looks a lot like 19.
Futures and options for gold, silver, platinum, and palladium. These are oldest contracts. I believe the silver future is launched sometime.
Present to this audience here. It's always wonderful for me to come to India. I love Indian food. It's fantastic. And I thank NCX as a wonderful partner as well in this event. Okay, so let me begin by talking a little bit about India. Now, I'm not an expert in India. I believe everybody here in this room are experts in India, so I don't purport to know more. But let me share a little bit of my understanding of Indian agriculture for this broader audience here, which I understand is a mix of different people from different commodity areas. I have to tell you that agriculture is a very exciting sector. It's been around for the longest of times, right? Since man lived in a cave, India is just simply consuming a large chunk of the world's production of edible oils. So again, very important, very crucial country to global agriculture. Not only that, there are certain products that India produces more than it needs, and those are the products that India exports as well. And I just want to highlight one of the commodities that has recently come to the front of the year. We permitted the usage of blocks in our markets, and we called it relationship-based trading. In essence, basically, the benefits of allowing block trades is it will help to facilitate large transactions relative to the existing order book liquidity. It will also allow you to trade very unique instruments like crush options or deep in the money strikes for the options itself. Or when you have the futures curve, the long dated futures contracts that may not have street liquidity, you can trade those as well using blocks. You can also use them to trade complex order types. So these are more technical orders like strip spreads, crushes, multi-leg options. A lot of people use them to trade strip spreads, for example, like quarterlies or yearlies as well.
So I can normally, manage my prices, manage my margins with a pass on actually. But I want to tell you about a few of the trends that are actually getting into the market, which are going to challenge you the way that you have been doing the business in the past and how you have to change over a period in time in terms of how would you look at your raw material prices actually. So hedging is a fairly simple process. Take the opposite position that you have in the physical markets and then you sit on it till you close your opposite physical market position and then lock in your margin. So that's about hedging. And when we talk about hedging, people normally